me and Dayananda sir are conducting the lecture for group B and B3 and B4. You are free to post some question. I know that even though you're asked to ask question, you may not ask questions, but during the session, if you have any question or clarification, you can use the chat box and post your questions. Let me first share the screen. Yeah, Dayananda sir, anything to add?
Yeah, it's okay. Continue.
Okay. Right. So I hope that everyone can see my screen.
Yes, we can see.
You can see, right? Okay. Accounting for revenue. In a nutshell, what like this is, we are going to talk about accounting, revenue, all those two terms, basically revenue. You have heard about revenue. And what is the big deal for us to talk about specifically accounting for revenue? Some specific technical aspects may arise and guide you to recognize the revenue. In fact, the whole course of accounting for revenue arises as a result of the periodicity concept, because we are preparing financial statements for a given time period. That is, standard time period is 1 year. Otherwise, we need not to worry about accounting for revenue. At any point in time, whenever you realize your revenue, you can account, you can recognize this thing as income. That's it. But that's not the case. So complication arises whether to recognize a particular revenue in a given accounting period. Why? Performance of corporations, performance of employees, managers, even the progress of the corporation is has to be measured periodically. So that is the reason. So therefore, we are trying to talk about different aspects to recognize the revenue for a given accounting period. Learning outcomes. Therefore, we identify basic issues associated with revenue recognition for what? For the period. Otherwise, we don't have any issues. Then, for the easiness, Standard has just developed a particular process called 5-step process. Rather technically, it tells you clearly how revenue is recognized. That means revenue is accounted in the books of accounts in very easy steps: 1, 2, 3, 4, 5. Then in the past, we did not talk about this aspect called contract with customers. But technically speaking, whatever the revenue from any sources, actually there is a contract, either implied or written or expressed or any means, there is a contract. So that is why, in order to make it a little bit of formally recognize it, we refer it to revenue recognition through a contract with customers, and determine the transaction price. So you know that in accounting, always we talk about recognition, no matter whether it is revenue, assets, liability, recognition. Actually, recognition cannot be done without a measurement. You need to have kind of measurement base. So therefore, the same thing comes here again. When we recognize revenue, we need to have a recognition criteria. That is taken as the transaction price. Revenue through the contracts with customers, therefore transaction price is taken as a base. There are some modifications, alterations, this thing, but as a base, we are going to recognize our revenue through or based on transaction price. Then application of five-step model, as it is show you, to allocate or recognize the full amount of the contract price over maybe in one period or maybe several periods. It depends on the nature of the contract that we have with customers. So before starting, the technical aspects highlighted in the accounting standard, simple demarcation between income and revenue. Or in other words, what is the relationship between income and revenue? Income, as you have already learned, it is nothing but an increase in asset or decrease in liabilities. But without any connection or any transaction arising with equity holders. If owners have not given money or we have just not given money to owners, so whatever the transactions done with owners, if you keep them aside, other than transactions with owners, any increase in assets or decrease in liability arising from any event is recognized as an income. You know it. For example, when we make a sale, so cash comes in, therefore increase in asset. Therefore, that is an income. Then what is the meaning of revenue? In Sinhala, we call income is adayam. Revenue, ayabare. Revenue is an income arising from the ordinary course of business. So therefore, most of the examples that we take are trading entities, either manufacturing or trading. Therefore, they make sales. Therefore, the main source of income is revenue. But at the same time, there may be different course of businesses. For example, banking institution is not selling anything but provide services. Therefore, its revenue is the income or the interest income taken from customers to from those whom loans have been provided, something like. So therefore, that is ordinary course of a bank is just dealing with money lending and keeping deposits, or maybe providing any other services, transportation services. So likewise. So nevertheless, um, the the income or cash flow comes into the business from its ordinary course of business is revenue. So therefore, revenue is inevitably an income. Now we will move on to the accounting standard, Sri Lanka Financial Reporting Standard 15, revenue from contracts with customers. So that is the name given. Specifically, it talks about revenue, what revenue coming from customers, but through contracts, revenue, contracts, and customers. So the objective of this particular accounting standard is to establish principles for reporting useful information. So it is like basically establishing or talking about basic principles for reporting useful information to users of financial statement, because you know that always our accounting subject, no matter whether it is accounting for revenue, accounting for lease, assets, liabilities, throughout financial accounting or even other accounting, when we use the word accounting, it deals with provision of information. It deals with information. It deals or it is in an information era. Information matters. Information provided in when it comes to financial accounting, financial statements. So therefore, specifically keeping that idea in mind, when it comes to revenue, we are going to talk about specifically these aspects. What are they? Nature, amount, timing, and uncertainty of revenue and cash flows. That's it. Nature, whether it is a sale, whether it is a service provision. Amount, how much? 10 rupees, 10 million, 10 billion. Timing, today, tomorrow, after 1 year. And uncertainty, whether there would be risks of receiving the same or not. You may have sold for 10 million to be received in 2 months. In 2 months' time, there is the possibility that you may lose something due to some other reason, or you may offer some discount, or you may make some arrangements. So therefore, some uncertainty also involved. So they are the key aspects of this particular standard. And at the same time, we must keep in our mind that when we talk about accounting for revenue, there were other accounting standards and some guidelines to deal with revenue. For example, LKS 11, construction contracts. When you build, like if your ordinary course of business is to construct buildings, in the past, we recognize the revenue of a construction company. For example, nowadays you can see lots of constructions are going on within university premises. So in the past, if it were in the past, that particular company should have recognized its income by using this LKS 11. Now anymore, this standard is not going to be used. We use the word called supersedes because of SLFRS 15. It supersedes, if overrides these existing things. In the past, we had, so here and there, different ways, different guidelines to recognize revenue. Now, we have done away with all those things. We have kept aside all those things, and we use this particular standard to recognize revenue all the time. So keep that in mind. So this is the five-step model. What does it say? Later we will be discussing in detail. Just to get some idea at a glance to identify what is this model, what are the steps, 5 steps, we have a quick glance. Identify the contracts with customers. The first one is the identification whether there is a contract with customers or not. Because from that point onwards, we can decide whether we are going to recognize revenue or not. In other words, the step 1 helps you to determine whether there is a contract. Actually, if there is no contract with customers, no way. Need not to worry about the rest of other steps. So therefore, it is very critical. We will see how it is going to be identified. So important for us to determine whether there is a contract. Step 2. Then we go to step 2 if there is a contract. Identify the performance obligation. Okay. If there is a contract, there are 2 parties at least. Without having 2 parties, you cannot have contract with yourself. I can't have contract with myself. So there is no meaning. So you can have your promises or maybe sometimes you can have some contracts with God. Sometimes we do like that, right? You enter into some contracts with unseen forces. But when it comes to practical situations or businesses, we need to have 2 parties. So then identify the performance obligation. So as far as now we talk about a trading entity, for the simplicity, we will take a trading entity, therefore company or the organization which sells goods. Then of course, on the other hand, there is a customer. Customer could be an individual or another company. One company sells goods to another company. The company that sells goods is the one who will have the obligation. If I'm going to sell products for my company, so it's my responsibility, my obligation to provide the goods as we agree. So that is the arrangement. So therefore, second step is to identify that particular performance obligation. Obligation is your binding. You are bound, obligatory. One organization, both organization would be obligatory. as far as the service provider or the good provider is concerned, you have to give the goods, sell the goods. That is your obligation. From the other side, the other party will give you money. Then another obligation is will be there. What really matters from the entity side is to identify this particular obligation, commitment. That is what we call performance obligation. When we use the technical words, sometimes that word may not be familiar with us. Performance obligation. We may be a little bit scared. Oh, what's it? It's not really a big deal. Simply, you agree legally and go through your own practice. You are under obligation. You have a commitment of doing something, either selling a good or providing a service. That's it. We need to check it. We are going to check it. Step number 3, then contract is there, performance obligation was identified. Then the transaction price. As I just told you, we can't recognize anything without having a measurement. So measurement basis or the criterion is the transaction price. What is it? We will determine it. To great extent when you do transactions or in your day-to-day life. So transaction prices, and you just go outside from the university, buy a lunch packet, so that the transaction price, maybe 100 rupees, I don't know, 200, whatever. So transaction price would be seen as very simple in that occasion. But when it comes to some contracts and agreements, so that would not be that easy. Some complication may be there, some adjustments may be required. But anyway, first we have to understand that. So there is a stage we need to determine specifically what the transaction price is. Step 4, allocate the transaction price. So why are we have to, why are we to allocate the transaction price? There are 2 instances here. Like basically, if the transaction is straightforward, simple, single, need not to worry about allocation. You take it and put it into your current period, that is your recognition. But in real business world, the transactions take place in a complex manner. One transaction may have different components, different items, different obligations to be fulfilled. So likewise, complexities may be there. So if that is the case, we need to allocate the full transaction price into different. So later we will be discussing. This is at a glance to get some idea. In one transaction, the organization may be providing many items. And sometimes a single item may be provided in many years. So 10 million obligation would be fulfilled over 3 years. How are we going to recognize? Okay? So that is the step 4 deals with. Then step 5 is finally, now we know how to allocate, say 10 million or 100 million should be allocated into 4, 5 transactions over 2 periods. Then we know the basic mechanism. 5th one is nothing but this extension of the 4th one. We record them in the books of accounts. When the performance obligation is satisfied. When the performance obligation is satisfied, we need to talk about whether we have fulfilled or performed, in other words. Simply speaking, if you use the simple words, whether you have sold goods in the case of goods, or whether you have provided your services. So there are some criteria to look in to see whether that has been sold or provided. So therefore, this would be a framework for you to understand. So Dayananda sir, anything to add?
No, you continue, no problem.
Sorry, I didn't hear you.
You can continue.
Okay, but if there is anything, just please stop me, right? Disturb me.
Right.
Okay. Now example number 1. Example number 1. This says it relates to ABC Limited for the year ending 31/3/2020. So just completed. So there are a few columns with information. First column, orders received. The second one, that is the date, order accepted date, order delivered date, and advance has been taken. You know that some transaction advances are given. Then the total order value and final settlement dates are there. What I have to do, recognize the revenue for the year ending 31/3/2020. Revenue. As far as the revenue is concerned, you need to look at this cutoff date, 31/3/2020. Then quickly have a glance. How are we going to attempt this? Order received, 1, 2, 3. All these three orders have been received before 31st March. Then there may be a consequence, or there may be a situation that you may need to recognize revenue from all these three contracts. But when we look at the order acceptance date, 3rd March, that is before 31st, then 30th March. This one, acceptance has been done on 4th February. So therefore, with respect to this, the last order, there will not be an instance of recognizing revenue in any means, because we have not accepted. So this is how you should develop your competencies of dealing with dates. So that this particular date falls after 31st March. So therefore, in any means, there is no room left for us to recognize the revenue. But there may be other consequences we look at. But in these two cases, there may be. Why? Once the order is accepted, only you can deliver the goods. The third column says, yes, goods have been delivered on 30th March. This one is in the following month. This one is also in the following month, that is April. And advance is also received, order value, final settlement. Then what would be the answer? We have a look. The revenue has been given as 250. Why? You can clearly look at here, order accepted with respect to this and goods delivered on 30th March. That is just one day before 31st March. Other two orders, actually we have not delivered. What does it mean? According to the standard, we have not fulfilled our obligation. That is the point. We have not fulfilled our obligation. Then if we go to this, performance obligation has not been fulfilled. Therefore, there is no point of proceeding further with respect to these two. So the only revenue recognition arises from this. How much? We do not worry about the amount that advance taken. So this is the revenue. So therefore, order value would be 250. 250 is the revenue recognition, and receivable amount is 200. Why? Already 50 had been received on this day. Therefore, that journal entry has been not shown here. So if you want to understand this in form of journal entries, this initial 50,000 received, bank debit, credit, advance received. In the name of that particular client, if you want, you can have advance received account or that client name. Then this journal entry is passed 250 on this date, 30th March. 250 revenue, credit, debit, or receivable. But the receivable balance will not be 250. Why? The advance is transferred to this, automatically receivable amount becomes 200. That's it. And that journal entry goes. And with respect to the second, the performance obligation has not been fulfilled. Therefore, you can't recognize. But at the same time, when you look at the advance column, you have not received any advance. So therefore, You better maintain some record, information about this thing, and when the perform or the goods are delivered, you can recognize 500,000 as your revenue. With respect to the last one, even though the obligation has not been fulfilled, you have received 60,000 in advance. Therefore, this leads to a liability, contract liability, because you have taken this much money with the promise that you would deliver goods, but you have delivered goods later on. Then on 31st March, you cannot recognize this 180,000 as revenue. So I hope that it is clear. So you should not get confused. These two items relate to the first contract. The last one relates to the third contract. Second one, no entry arises. Now, we are going to explain you this 5-step model with an example. What is this example? Assume that Colombo Dockyard, it's a company, shipbuilding company, signs a contract to sell a ship to Sri Lankan Navy for rupees 100 million. So contract has been signed, right? Therefore, we need not to discuss even automatically. You should decide yes, yes, yes. So contract is there. We can recognize. Step 1, identify the contract with customers. Yes, that's there. So therefore, we can proceed further. Second step, we can go to the second step. Identify the separate performance obligation in the contract. What is the separate performance obligation? From the dockyard side, dockyard has to sell this particular ship worth of 100 million. So that is there. As only one performance obligation, like this one obligation may be gradually built or constructed over a longer period of time, because you can't sell a ship without constructing it. So construction cannot take place within a couple of weeks or cannot overnight. It takes time. Labor is there, materials, lots of things, and it's a complex process. But your obligation is to sell it at the end. You need to hand it over to Navy. Third step is to determine the transaction price. So that is also straightforward with this information. Nothing much, nothing less. It is 100 million. Very clear. Right? So when can we recognize it? Allocate the transaction price to separate performance obligation. We have only one performance obligation. Therefore, once the ship is handed over, you have to recognize 100 million. So that is straightforward. It may take 1 year. It may take 6 months to build the ship, but you recognize it on the day the ship is handed over to Navy. The last point, recognize the revenue. So we assume that Colombo Dockyard handed it over to Navy. Therefore, this 100 million would be credited to revenue account and debited to receivable account. Once the cash is received, then you know the normal journal entry, because you have mastered these journal entries over time. Now, another example, actually this is an extension to the previous example with the same 5-step model, but with little modification. What is the modification? We assume here Sri Lankan Navy provides 1-year service contract for 110 million. So transaction price includes 10% of the price of the ship for the service. So this is the transaction price, 100 million. 10% of 100 million is 10 million. Therefore, the full transaction price is 110 million. There are two components. We'll see how it is going to be recognized. The first one is the contract identified. So I can skip that one. Second one, identify separate performance obligation. So here, the first question that we have to ask whether there is a single performance obligation or several. In this case, there are two obligations. There are two obligations. One is to sell the ship, other one is to provide the service. Therefore, there are two. Determine the transaction price. So total transaction price is 110. That is the determination. It's given, straightforward. But the fourth step, allocation, will not be 110 million as your revenue from sales. So it is divided, your revenue is divided into sales, 100 million as sales, 10 million as service charges. So that is, this information should be provided as a note in your revenue in the income statement, assuming that this is the only sale or only transaction that Dockyard did in a particular year. Therefore, in the income statement, it is shown as revenue 110 million. But as an additional note, it's good to like what we call segmental reporting even. So later on you would be learning. But this classification is important. Therefore, in a note, you say revenue from sales, 100 million, service, 10 million, altogether 110 million. So this should be recorded in your ledger. I hope that so idea is very clear. Actually, this accounting for revenue, don't take this thing as a big deal. Don't be subject to difficult words used in the standard or uncommon words used in the standard. So that is the problem that to great extent students face. So you are worried, you are frightened by seeing these words, obligation, that and this, then as a result, you would be frightened. Actually, it is very simple, nothing. Even ordinary level student can understand this thing. Or whoever who can understand basic thing, if I explain like this, I hope that if you have basic intelligence, anybody can understand this. So first, actually, if you can deviate from traditional mentality of accounting, of putting items debit credit, it would be much easier for you to understand. If all the time, if you think whenever we talk about accounting, what comes to your mind, if what comes to your mind is debit and credit, so that would be a disaster, because you can't understand them. So if you carefully understand, read this transaction, you will realize that, oh, debit credit is nothing here. It is very straightforward. Simple transaction, simple amount, anybody can do. Even nowadays, or especially in future, these debit credits or recognition part, recording part, will not be done by professionals, will be done by machines. The professionals will decide the first step 1, 2, 3, 4, not the fifth one. But we simply forget about 1, 2, 3, 4, and decision making part. We jump on to the fifth one and debit credit and think that, oh, yes, we achieved big things. Right. Already I have explained it, but here again, we pay more attention to some technical aspects. Basically, if the question says or the situation tells you some information that there is a contract which has been signed by both parties, so you can conclude that yes, there is a contract. So what are the salient features of such contract? So contract is an agreement. Especially this comes from the basic law which we call sale of goods when it comes to sales goods. An agreement between two or more parties that creates enforceable rights and obligation. Enforceable. It must be enforceable. However, that enforceable contract can be either in written. If it is in written, enforceability would be easy. Maybe oral. On oral, we can enforce, you can provide evidence that yes, this we agreed. You may nowadays, so even you can have some evidence. Or sometimes implied. So no oral, no written, implication may be there. You so may have given your consent without saying anything. That means so you accepted. You had a certain past relationship with the customer. Customer place an order, you didn't say anything. That means you accepted. So that is the implication. So these are the technical things to understand. It's required criteria: approved contract. The written, oral, or implied should have been approved. Then parties have commitment to perform from their respective. Seller is giving the goods, buyer is giving the money. Each party's rights. Seller and buyer. Buyer has a right to take the goods in good condition, whatever the thing, in good condition as agreed. You know that famous now online transactions, AliExpress, like where there are good platform, but AliExpress is very famous. Um, it has a policy. It has a policy to protect the buyer's right. The policy gives you a customer protection period. Basically, that is 30 days, maybe because of COVID, now it has gone up to 60 or 90 days, whatever it is. You have a customer protection time period. So during that customer protection time period, the seller, because the AliExpress just provide the platform only, so that platform helps or enables to meet buyer and seller. If I buy something, order something, some seller sells, then deliver the goods may be shipped. Say 60 days are given to me. That is the customer protection period. After 60 days, customer has a right, in case if the customer will not receive the product, to claim the full price. The AliExpress says that is guaranteed. If you do not receive the product, the full amount would be refunded. Or you can claim that the product is not as agreed, not in accordance with the pictures shown or the other explanations given. So therefore, you have the right of even rejecting the goods received. So you have, that is called parties right. You know, the practical, I would like to tell you practical instances of in a way that is not good. Countries like Sri Lanka, India, maybe other countries. So bad reports also have gone to AliExpress now. Even if you receive the goods, that tracking system, because finally goods are delivered to you, uh, there is no evidence that it was delivered to you, because the post office, finally, if they check it, it could be traced. But if you claim that you did not receive, so you would be refunded. So that's bad for the transaction. But even if you claim that you did, like within the given time period, if you do not receive it, you can claim, then you would be refunded. Even after the refund, there's a chance that you would get it. So nevertheless, I just told you this particular story to understand in any form of transaction, virtual transaction, online transaction, physical transaction, the parties' right should have been protected. Otherwise, business transactions, um, like you can't carry on these things. So at the same time, the seller also should have the right. What is the seller's right? To take the consideration price in kind. So both parties' rights are. Entity can identify the payment terms. So it's straightforward. Sometimes on the spot, maybe 1 week, 2 week, 1 month. It depends on the arrangement. That's what we call business practice. Sometimes some customers are given 6 months credit. So that's the practice. Then the contract has commercial substance. So this is a technical wording. This the importance of this can be identified actually when it is going to be enforced in front of a court. Sometimes you may claim that there is no commercial substance. Things may have been given as gift, right? So you may claim that no, so it was given to me as a gift. I thought that uh, these kind of issues may arise, gift or any other arrangement when there are conflicts or disputes between parties. How it is going to be settled through the mediation of a court or the legal mediation, the very first thing they check whether there is a commercial substance. It has been intention of doing these things. So how do you check the commercial substance? They take into account all these aspects, which is the consideration, price, intention, your practice, all those evidence would tell you whether there was a commercial substance or not. So from accounting side, need not worry that much at this level, but from legal side, yes. Then it is probable that the entity will collect the consideration. So if you can't collect the consideration, you can't recognize because there is no contract. Then consider whether the entity obtained the right, as already explained, and assume obligation. The combination of those rights and performance obligation gives rise to an asset or liability. So what are the assets? When you sell, your asset would be in form of receivables or cash or the money that you have spent for the good. Liability, you may have received money in advance, but still the performance obligation has not been fulfilled. So possibilities that would arise in relation to a contract with customers are assets, net in form of net, finally, assets or a liability. So there is an activity. You take a few minutes and try first. So then we will look at the answer. Otherwise, you would not be able to grasp. On February 1st, 2020, let's assume this year, Arun PLC presented a proposal to transfer a machine for rupees 5 million to JK Holdings. Arun is the seller, JK is the buyer. Amount is given there 5 million. On 1st March, that is after 1 month, JK Holdings accepted. JK Holding is the one who is going to sell. Arun PLC presented a proposal to transfer a machine. Actually, this wording confuses you. It's a kind of proposal. That proposal wants like JK to transfer a machine to Arun PLC. It looks like sorry, yeah. What I said was correct. Huh? Earlier position was correct. Actually, Arun PLC presented a proposal to transfer a machine to JKH on this date. After 1 month, that is on March 2020, JK Holdings accepted it. That means JK says, okay, you would buy it and entered into a contract. As per the contract, Arun requires to transfer the machine on 30th April and JK Holdings to pay the full amount on May. Again, after 1 month. February, March, April, May, 4 months. Within a 4-month time period, the cost of the machine was 3.5 million. What are you supposed to do? The question number 1. Did a contract exist? When? On this date. Did a contract exist on 1st March? What is the value of the right? What is the value of the right of Arun PLC upon the acceptance of the contract? What is the performance obligation of the Arun PLC upon the acceptance of the contract by JK Holdings? I'll give you 5 minutes for you to attempt the question.
recording එක නවත්තුවා නම් හරිනේ.
ඔව් විනාඩි පොඩක් දෙමුනේ. ඔව් රෙකෝඩින් වෙනවා. පෝස් කරමු නේද?
ඈ
පෝස් කරමු නේ.
ඔව්
I'm sorry that.
Okay, now okay.
Okay. Right. Sorry that I could not restart the recording. So no worries. We discussed about the answer. Now we are talking about in details uh, the second step, the identification of the performance obligation, where I just explain you the meaning of explicit, implicit, and the customary businesses. Explicit means specifically you write down or communicate between two parties what you want. Implicit means it is imply when you buy something, as in the case of buying land, shirt, or any other things. That is there. Customary practices. So there may be some things which are done as a customary practice. It also becomes the obligation finally. Then, in identification of the performance obligation, sometimes
No.
the provision of goods or services is seen to be a bit complicated, cannot be separately identified, may not be distinct from each other. Sometimes it is distinct, it is easy. Why it matters? If it is distinct, it is easy for us to allocate the transaction price among distinct items. But if it is not distinct, can we allocate in that way, or should we recognize in a different format? So that is the purpose of identifying obligations separately. Example, selling a ship is different from providing a maintenance services for the ship. So in addition, like most of the cases in the field of machinery businesses, office equipments, software. So apart from the main sale, service provision comes along with that. Sometimes that particular the service is a part and parcel of the product. Sometimes it can be done independently. We need to ask this question. If the goods or services are not distinct, those performance obligations are combined and reported as one performance obligation. So we can further understand that aspect by looking at activity 12.2. A software development firm enters into a contract with a customer to transfer the following: software license, installation service, includes changing the web screen for each user, software updates, and technical updates for 2 years. The entity sells above options separately. So this is additional information. The installation service is routinely performed by other entities as well and does not significantly modify the software. So when you install um, installation of services, it can be done independently, does not have any implication of the function of the software. The software remains functional without the updates. Yes, without having updates, it can function. And the technical support. Are the goods or services promised to the customer distinct in terms of part 15? So if you read this thing as an ordinary person, we can easily understand that these items are separate from each other. Therefore, we can say that these services and goods are distinct from each other. Therefore, you can recognize revenue separately. Activity 12.3. Techno Private Limited enters into a contract with the customer to provide a customer relationship management software. It's again selling a software to manage or deal with customers. In addition to providing the software, Techno Private Limited promises to perform consulting services by extensively customizing the software to the customer's IT environment. So this may be a common software, IT software, but this company says that no, so we can modify this particular software to fit your requirement, your customer requirement, and your IT environment and all these things. So don't no worries. The total consideration of the contract is 900,000. So that is how it is agreed. So therefore, with this phrase itself, it implies that software cannot be used as it is. It has to be modified. It has to be fixed. It has to be adjusted to your environment. So therefore, we can simply understand that they are not distinct. They depend on each other. So therefore, it's a very simple question. We should not ask. So straightforward answer is there. Now step 3, determination of the transaction price. Determination of the transaction price. The amount of consideration in a contract which an entity expects to receive from a customer in exchange for transferring promised goods or services. So technical definition understood. An entity shall consider terms of contract and its customary business practices to determine the transaction price. When a performance obligation is satisfied, so that is a key. When the performance obligation is satisfied, that has to be checked. That is the point where we can start recognizing the revenue. An entity shall recognize revenue, the amount of the transaction price. So therefore, the measurement basis, as I just explained earlier, is the transaction price that is recognized as your revenue. Finished. May be allocated to single performance obligation, single product, or many. Also, it depends. Transaction price is usually fixed. So under normal circumstances in normal accounting that we have learned in preparation of financial statements and trial balances, ledger accounts, and everywhere, you are given the value or sales price, sales value, sales account, revenue account. So it's easy. So here also, the when we talk about revenue recognition, actually this full aggregate amount comes as a result of accumulation of many sales revenue. So easiest identification way of identifying sales is the fixed amount, fixed consideration that could be seen when we buy a car, fixed consideration, $10,000. When we buy a telephone, 20,000. So that is fixed. You paid 20,000, you bought the telephone. You paid 1,000 rupees, bought a garment. That's it. But sometimes it may include what? Variable considerations or non-cash consideration. Variable considerations means some kind of offers when you buy in large quantities, when you mix the product sometimes, price can be adjusted or discounts may be given. Non-cash consideration may be in terms of goods, maybe goods, the discount, not the cash discount, goods discounts in goods, or maybe any other arrangement, just provision of additional service. That is non-cash consideration may be there. We'll take one example and see. Examples: discount, refunds, price concessions, performance bonuses, rebates. Rebates are the things that are given back when you purchase subsequently, right? Maybe repeated orders or any other things. So you are entitled to have a rebate that relates to previous, or maybe pertaining to some other conditions. From your full invoice price, amount is deducted. That's not a discount. It has a connection to some specific things. Then the credits, incentives, and even penalties. So that's also added on. If you do not make the payment on time, penalty charges would be there. If the consideration is variable, that is changing, an entity estimates the amount of consideration and it will be included in the transaction price only if the following conditions are satisfied. Actually, when it varies, when it is going to change, you can't recognize, you can't make the alteration all the time. You need to specifically check when that changes happen, when you are confident or adequate, when you have adequate information to recognize the revenue. Entity has experience with a similar contract. So maybe with the past experiences, entity knows that this particular buyer will. mm, okay. So who is? Please don't use this annotation button. Otherwise, I will have to disable all these things. So okay. Then entity has the experience with similar contract and can estimate the cumulative amount of revenue. Based on experience, it is highly probable that there will not be a significant reversal of previously recognized revenues. Actually, these variable conditions can be identified in two situations, either it is specifically mentioned or maybe from the experience. Activity 12.4. Comfort Bed Private Limited enters into a contract with the customer on 1st January 2020 to sell beds for 4,000 each. One bed for 4,000. If the customer purchases more than if a customer purchases more than 1,000 beds in a calendar year means starting from January to December, the contract states that the price per unit is reduced to rupees 3,800 per bed. So within bracket it is mentioned as including prior purchases of the same item. What does it mean? Assume that a customer bought beds in the month of January. By that time, you did not have information, or maybe in November, you do not have information that customer would be entitled to have this discount. But the first week of December, you get to know that customer would buy more and would be entitled to this particular discount. If that's the case, you have to offer the discount for the items bought in November as well. So that is the meaning of that phrase in red color within the bracket, including prior purchases of the same. As at 31st March 2020, the end of the first quarter, company had sold 80 beds. In one quarter, 80 means if you continue the same pattern, another quarter maybe 80 or 100 maximum. So 4 quarters, it would be around 400. It is unlikely that that particular customer would be able to get the discount. Therefore, it estimates that the customer's purchase will not exceed 1,000 bed threshold, which is required for the volume discount in the calendar year. However, at the beginning of June 2020, after 3 months, the Comfort Bed acquired another company, so that is their internal business matters. So as a result, the company has been able to sell an additional 500 beds to the same customer during the second quarter ending 30th June. So now, by the end of June, that is within after the second quarter, additional 500 beds did the previous 8,580 beds have been sold. And the company also has the capacity to do so. Considering the new facts, The comfort bed now estimates that the customer will purchase more than 1,000 beds in the calendar year. What is required then? Decide whether the consideration of the contract is variable or fixed. Revenue to be recognized for the first quarter, revenue to be recognized for the second quarter. Take 2 minutes and decide. Not much time. Quick glance through. I'm not going to hold it. I'm not pausing the recording, just 1 minute or 2 minutes. All right. Um, the recording is running, right? Just check with the recording. Diana, is the recording going on? Yes. Okay. Now we'll have a look at the answer. It's variable. As the information says that price can be changed. Therefore, it is a variable contract. The second one, revenue to be recognized for the first quarter. At the end of the first quarter, in fact, the company did not have this additional information that the sales volume would reach to 580. So therefore, comfort bed does not have any right, or comfort bed is not in a position to offer the discount. Therefore, revenue has to be recognized at the rate of 1,000. 4,000. Therefore, revenue for the first quarter, 4,000 into 80. 4,000 into 80. But at the end of the second quarter, June 2020, you have the full information. So therefore, revenue for the second quarter should be 3,800 into 500 beds, 1.9 million. And from that, you have to deduct the discount which is offered for the previously bought items. Previously bought number of beds, 80. From each bed, there is a discount of 200. That is the difference between 4,000 and 3,800. So 200 into 80 is 16,000. Therefore, your revenue to be recognized for the second quarter is 1.884 million. Non-cash consideration. Sellers sometimes receive consideration in a form of other than cash. Example, receive of inventory as the consideration. So how are we going to account for this thing? Therefore, revenue should be generally recognized at the fair value, because in the case of the previous case, variable consideration, it's a discount. Easy to measure it, identify. 200 multiplied by the number of items, straightforward. But the second one, you are given some item, maybe concessionary product, gift item, or something else, maybe due to the customary business practice. So how are we going to adjust it? What would be the amount at which the transaction should be recognized? So where you need to use the concept called fair value. Fair
අපි
value.
සීමාවට ඇවිල්ලා තියෙනවනේ. අද අද සෙෂන් එකේ අන්තිම හරිය වගේ ඉන්නේ.
Oh, from this we will stop.
Okay.
Okay, from this we will stop. Yeah, non-cash consideration. So fair value has to be taken. I'm not going to talk about the fair value because already we have learned about the fair value. I just remind and ask you to recall what you learned. But in simple, at a glance, you can understand the word fair does not have very clear meaning. It's a vague meaning, but simply speaking, you can refer it to reasonable, orderly, well-functioning, efficient market price. Simply speaking, a good example you can refer always, as I just tell, the perfectly competitive market. So that's not there, but orderly, well-functioning market. If that is not there, we have other alternatives to determine the fair value. You better go through all those things. And if that's the case, you have to take the fair value of this. I think this time value of money also can be taken. Like, we'll discuss this and stop. The answer. Yeah, before taking the then the time value of money. Sometimes the transaction price is also adjusted for the effects of the time value of money. Time value simply means the difference between the two values. One is at present, the other one is in future. So that is the time value. If 100 rupees today is exchanged for 110 rupees for tomorrow, time value of money is 10. So time value of money has to be considered if transactions entail significant financing arrangement, significant financing component. So in order to check whether there's a significant financing component, we need to look into the transaction and all those things, arrangement. So if the obligation or the right to receive consideration or the purchase price would be delayed due to particular arrangement, then you need to consider the time value of money. For example, consideration paid in advance or in arrears, that means after 1 year, 2 years, something like, if it is significant to the contract, could be adjusted for the effects of the time value of money. So you have some understanding about the time value of money, learned previously in other subjects, even in accounting. So use that knowledge and deal with this activity number 12.5. So here it says an exception, however it is, even though there is an incident that the time value of money arises, or we need to adjust the consideration to its fair value by using the time value, that is the discounting process. You have an exception when the interval between the transfer of goods promised or services rendered, the payment by the customer is expected to be within a time frame of less than 12 months. It does not require to adjust for the effects of the time value of money. So it's a practice. So normally within the ordinary course of businesses, depending on the nature of business, customers may offer different credit terms. maybe 1 month, 2 months, 3 months, 6 months, likewise. If that is the normal, ordinary practice of the business, you are not supposed, even if it is 12 months, not supposed to make the adjustment for the time value of money. Even more than 12 months, even 2 years, 3 years, if it is the normal practice. So it's very hard to find such a situation. But technically speaking, if that business gives 2-year credit, maybe due to huge, heavy assets, do not know, we can imagine. So if it happens within the ordinary course of business, we need not to adjust for time value of money. Otherwise, we need to adjust for it. So the adjustment for the time value of money would give rise to a finance charges. So keeping with that in mind, we would conclude. And this is the activity 12.5. You can note it down, or otherwise we will, Dayananda will we update this in the LMS without answers? Dayananda sir?
Oh, yes.
Okay. So otherwise you can quickly note it down. Prepare journal entries to record revenue on 1/4/2020 and 31/3/2021 and receivables on 31/3/2021, 31/3/2022. Write them down and attempt the question and come with the answer on next Friday. The same online classes. We will give you the Zoom link in our LMS. Both groups, B3 and B4, should join in one lecture. Me and Dayananda sir will be there to discuss about this. So as Dayananda sir informed, because I was not aware of that fact, I was under the impression that by Friday we would be finishing our lecture series, but it's not the case. We will be finishing it next week. You have an additional week, and the next content in the syllabus would be discussed. As I remember, maybe consolidation, basics of consolidation. Sometime we would be able to start the consolidation even on Friday. And please carefully go through today's session and practice these activities again. Note down any points or anything that you want further clarifications. If you have any question, you can either send them to LMS or post it next time, then we would answer. Are there any questions arising from students? Dayananda, are there any posts in the chat box?
No question.
No questions. Okay then, thank you so much. So have a nice day. We will see you on next Friday.